So, security analysis. Even though the chapter name is security analysis, we will focus on equity shares. Some basics of stock market we have discussed already in the our basics chapter. I'll quickly run through it. Let me know if you want me to cover any topic. I will not spend much time because we have discussed already in the basics. So, what is a market? It's a place where buyers and seller exchange commodities, services. Rather than using the word buyer and seller, we can use the word situations of supply demand. For example, we also use the word money market. We are not buying and selling, we are borrowing and depositing. People also use the word matrimonial or job market. So we should not say buying and selling. We just say that people with opposite intentions. If market has to happen, there has to be a buyer, there has to be a seller. Money market has to happen, there has to be a lender, there has to be a borrower, or depositor and borrower. So two opposite requests should come together. That is where market is created. Stock market, currency market, money market, and so on. Indian security market, uh, in general stock market, you will have a buyer and a seller, but they cannot come to stock exchange and deal on their own. You need the help of members of stock exchange called as brokers. So if you want to buy also, you have to go through the broker. A seller also has to go through the broker. And that supply curve and demand curve together only market price is determined. I also discussed about the pre-open market session. But anyway, any price in the world, for that matter, there has to be a supply curve and demand curve intersecting. That is where equilibrium is obtained. I have discussed this in the basics. Indian stock market starts at 9:15, ends at 3:30, but actually at 9:10 there will be pre-open markets, and there will be four kinds of prices, and every day open price, and today high price, low price, the market price will fluctuate, and close price at the end of the day. And we have pre-open market session because to determine open price, we need to know assess the or demand order, supply orders, buy order, sell orders. That is where it is determined in pre-market session at 9 o'clock to 9:07, not 9:10 actually, 9 to 9:07. Then 9:07 to 9:15, there will be a gap, cooling period. From 9:15, the trading takes place. It's 9:07 to 9:08. I think I should change it. It's at 9 o'clock to 9:08. That is a pre-market session where the orders are allowed. Orders are allowed, but not executed. 9 to 9:07. But then 8 minutes, that will be for a cooling period, just for safety purpose. 9:15, the open market starts. And how the stock is purchased, I have purchased in my basics also. I showed you by practically executing one, purchasing it. I logged into my Zerodha account and I did it. Hope you remember it. So buyer, he has to come through his broker to stock market by placing the order, buy order. Seller has to come to the stock market through his broker, through his sales order. Then order matching will happen, quantity and price, the buy order, sell order. If it matches both price and quantity, the price determined, and later the delivery takes place. Shares will be delivered and money will be paid. Delivery of shares and money, and payment will take place. In India, we follow rolling settlement. We say T plus 2 days, transaction plus 2 days. So if you place the buy transaction taking place today, let's say Wednesday, you will get the share to your account, to demat account, only on Friday. If you sell it on Friday, the money will not come to you on Friday. Money will come to you after 2 days. So Monday, Tuesday, after the T plus 2 days, where it will take for you to credit the amount or for the credit of the shares that you have acquired. Okay, so that place discussed. Shareholder making a order to buy through his broker, you make the payment. It will be transacted through clearing house. Shares are delivered through ShareCan, SBI Cap, Zerodha, like that, and you receive the shares. Similarly, seller also, you place the order to sell, you deliver the shares, it will be transacted through clearing house, the buying and selling takes place, and the person would have makes the payment and you receive money. The whole process is T plus 2 days. Ownership structure, physical structure earlier, we call it as physical certificate, share certificate, still applicable for private companies. But for listed companies, we have converted this into a non-physical format, dematerialized format, no material, dematerialized, that is demat, everything electronic, digital format. And the digital format, you need to keep two people in mind. One is depositories, other is depository participants. Depositories in India, we have two, NSDL, CDSL, who are responsible for maintaining the records, like share certificates to be issued, or share name, owner's person, register of members, like that you have to maintain, right? All these documents will be maintained in digital format. At any given point in time, who is the shareholder of a company? Depositories will know it. At any given point in time, who is eligible to vote? Because you have to pay dividend, means register of members to be looked at, and then transfer of shares takes place when you sell the shares. So share transfer forms, or from which person to which person that is transferred. So all those data, everything in digital format is in depositories. They are like a data warehouse responsible for maintaining records and transactions. Then we have depository participants. They are like they are basically stockbrokers. Like you open bank accounts with different banks, you can open depository participants. One, many people are not aware, HDFC Bank is different. HDFC depository participant is different. They are two different entities. They may be promoted by banks, but they are different entities. For example, we have SBI, which is bank. Then we have SBI Cap Securities, SBI Cap Securities. That is broker, depository participant. So whenever you want to transact, you should always open a depository participant. Most popular number one broking firm as on date is Zerodha. They have their own success stories to tell. You can watch YouTube videos. Lot of videos are available. A good thing to learn. Many things to learn from Zerodha. How they were, they made the change in the history, in the dominating business of stockbroking. And as of now, many companies are, many depositories are there like Zerodha, but Zero was the pioneer. They are from our state, Karnataka. You can read through their own stories. Many things to learn, not only in business, but also in life. But anyway, so they don't charge any brokerage for equity transactions, zero brokerage. Only for derivatives and intraday they charge. Anyway, so you can open as many demat account as possible. Usually people have for different transactions, different demat account. It's like as good as opening different bank accounts. Okay, so that's the ownership structure I would like to maintain. Now, while selecting the companies, this is two important terms that you have to keep it in mind. In my stock market basics, that is mini workshop, that's available in YouTube also. I hope you already watched it. When I start with the equity valuation, this I would have talked about it, but I'll discuss once more. Fundamental analysis, technical analysis. These are the two typical words you will definitely come across in stock markets. Fundamental analysis is basically applicable for investors in long term. Technical analysis is basically applicable for traders in short term. So fundamental analysis focus on valuation. Technical analysis focus on pricing, charts. So many things can be looked at. So let me do one thing. I would have given the example earlier. I still give the same example now. We are out of almost Corona, but still in 2020, March 2020, I would have given the same example, but I'm repeating the example. I'll try to give some more examples going forward. In 2020, March, lockdown happened. Stock market was already getting crashed. Actually, that was the perfect time to invest. because market has recovered in a V shape after that. But at that point in time, nobody or most people did not have the courage, including myself. Had you invested there, what would have happened now? Everybody knows it. Everybody will talk about it. But it's easy to say now in the hindsight, looking backwards. But at that point in time, it is definitely very difficult to take that decision because you're trying to save that money. But anyway, uh, but one thing I would like to tell, in case of crisis, always invest. Close your eyes and invest in good companies. I'll tell you different techniques. Today might be slightly again more theoretical day, more talking about stock market, in a way stock market workshop repetition in some way, but I would like to spend that time. In crisis, you invest for two simple reasons, also one reason also. If the crisis ends, your share price would have gone up, you make profit. If the crisis does not end, you will be end. No, I mean, crisis does not end means you will be closed. Then what's the point in having money with you on cash? Anyway, you are not there. That would have been a simple analysis during Corona stage. See, Corona, you think, okay, world is going to end. In that case, what's the point in having the money in cash? You're not going to use. Anyway, your will not be there. If crisis ends, only two things possible. If crisis ends, then share value would have increased. Anyway, keeping that aside, what analysis I did, quickly I tell you. Lockdown situation, I know there has going to be more dependence, consumption of internet. So I thought, okay, let me select which company which is supplying good internet, popular. I gone for Reliance. I invested at around 1000, not 1000, maybe 900, 800, maybe 1000 approximately. Now it's more than 2000. And one more thing I did, okay, which sector will not be affected more much? That was IT sector, because IT sector, anyway, people don't work. I mean, just on lighter note. But they, if they're working, whatever little they do, they can do work from home also because they work on internet. So I thought, which is the internet company, which is IT company, I like Infosys. So I went for Infosys. You could have gone for TCS also. So those are the two companies I invested during pandemic. Now I wish I should have invested a lot more. Okay. Now what is the which company to analyze? Which sector to analyze? Now don't look at market is always a forward looking animal. In the sense, what could happen based on that anticipation, they take it today. Like, should we invest in Adani Group? Should we invest in Reliance Group? Some people say, oh, Reliance Group, good. They have a good history. They should be invested. Reliance led by Mukesh Ambani, good. That is fundamental analysis. Or somebody people tell Adani Group, they are not showing good profits in the history. Only everything is, some people say it is scam. In the books, nothing is showing. That is fundamental analysis. Or some people say, no, no, let's look at the charts. You see, the charts goes like this. It is at high time. Now it will come down for sure. Let's book it. One of the opinion Adani stock was like this. True or not, I don't know. Was opinion like this. The stock went up like this. Usually when stock goes up, it goes like this in a non-linear manner. It goes up, it takes correction. It goes up, it takes correction. It goes up. So that in a gradual manner, share price will increase. But what happened to Adani Group, it just went up like this. There was no correction. So people were telling when something goes up too fast, it has to come down. And that is what is called as technical analysis. So focusing on fundamental aspects of the company, sector, who is the leader, what is the ratio, what is the P&L, what is balance sheet, those kind of things when you look at, that is called as fundamental analysis. But when you look at charts, technicals, there are so many different types of charts available, ratios, supports, resistance. We have like relative strength index. We have super trend. So many technical indicators are there. looking on the charts. That moving average, simple moving average, exponential moving average. That is technical analysis. So those people who look for short-term gain, they call it as swing trading or intraday trading. They go for technical analysis. But we people, we want to invest for long term, then we should go for fundamental analysis. If you are investing through stocks, investing through mutual funds, we'll come to it when we talk about the chapter mutual funds. Okay. Now, how do you select companies? I gave you example, right? Corona situation. So, in Corona situation, I started with economic point. From that economic situation, I went to which sector does well? IT sector. I went to industry level. From the industry level, which company does best? Company level. This is called as top down approach. Start from economic level, come to industry level, from industry level, come to economy company level. You can do many more analysis like this. And one more example, if I have to give, latest what is happening, there is good price for or good prices coming for metal stocks, metal prices, copper, steel. They're having a good price in the international market. You start with economic level. Then you went down for, okay, in that metal sector, which, I mean, in that metal, which is better? Okay, steel sector. You went to industry level. In the steel sector, which company does best? SAIL or Tata Steel, JSW Steel, company level. That also give you good return. Or you can say that, oh, I think we should look at India. India as a whole means, I think we should go for banking service. That is the future. You come to industry. In that banking, which company is best? You can go for private banks or public sector banks. Somehow, many analysts, to an extent, including myself, is not so confident in public sector banks like Canara Bank, Syndicate Bank, State Bank earlier. Now every state bank is combined. Somehow people don't, I mean, analyst, maybe I have a personal bias, I don't know. But public sector banks, we usually don't recommend. Let's say I'll take my individual opinion on that. But of course, last few months, SBI and all has gone up like anything. But my opinion, why? If you had experience, you would have come to know that how public sector or government employees work. They hardly work. There is one common joke, no, in on State Bank of India. Everything you go there, they tell lunch break, come later. So one time, one Zomato delivery fellow went to deliver food during lunchtime. What would be the SBI employees' reaction? Now is lunch break, come after lunch break. I mean, they are so used to telling that. Anyway, so the point is, we, at least analyst, individual, I am having more focus on or more confidence on private sector bank, ICICI Bank, SDFC Bank. Now looking at that, okay, there are investors like foreign institutional investor, domestic institutional investors, retail people, and we usually consider FIIs as smart because money is coming from foreign country. We assume they would have done the research. True or not is secondary. Let's say we depend on them. Nobody knows the future anyway. And HDFC Bank, if you see the ownership pattern, lot of FIS holdings are there in HDFC Bank. So, okay, let me purchase HDFC Bank. So, let me look at the ratios. What is NPA? What is the price to book ratio? PE ratio. By looking at this ratio, if we make a decision, that becomes fundamental analysis. Okay, so I'll just take you through websites. Just 1 second. Okay, again, I'm giving very brief example I'm limiting myself for exam purpose. If you want to learn more about stock market, I'm doing daily series in my YouTube channel Hegde's Hedge, where every day I'm talking about some concepts and day events, how to view the market. So you can join every day. Either I'll do it at 9 a.m. or 9 p.m. Today also we are having a weekend. I'll be doing a weekly roundup. What happened in the last week? Okay, so is the internet visible? So many websites are there. So I go to a screener website. It's a very neatly arranged one. Lot of websites are there. Money control is there. Value research is there. Many are there. Let's say I select screener. Let us take Infosys, or let's take Reliance. Of course, you have to look at their annual reports, director report, so that we'll get the guidance. Looking at the guidance, we can know the growth rate of the company. Looking at the product structure, their future plans, their capex expenditure plans, so we can do FCFA valuation. We can arrive at the value per share. For that, lot of assumptions are required. Where do you get the assumption? From annual report. So these are all called as fundamental analysis. But one important point that people ignore is, more than these ratios, always look at the management. You can say promoter. In my opinion, that is the deriving factor. If management is not reliable, you giving the money in a company, you're investing in a company, means you are doing that business. In your money, they are doing the business. So if the people are not trustworthy, if the corporate governance issues are there, I recommend stay away from those companies. Reliance Industries, Mukesh Ambani, you know it. Infosys, of course, Narayan Murthy was there. Then Mr. Kamath came. Then one more person is there now. Any important company you look at, leadership matters. Like now people are talking about IDFC First Bank. Leader is Mr. Vaidyanathan. Lot of confidence is there on him. Adani Group. Adani, whether you trust him or not, if you trust that person, invest. Otherwise, don't invest. So the person's management matters a lot beyond these numbers. Okay, so let us look at Reliance Industries. P ratio is 31 times. Is it good or bad? I don't know. Let's look at its competitors. P pairs. P ratio 31 as compared. Okay, that's a problem with Reliance Industries because they are having so many sectors. They are into petroleum earlier. Now they are into everywhere. So this P ratio is very difficult to compare. They have given only petroleum companies as comparison. Okay, difficult. ROE 7.97, 8% approximately. Not very great. Our FD rates are also approximately same. Book value 1042, current price 2000. So double of book value, or price to book ratio we say 2:1. Dividend yield little bit less. Actually, Reliance don't pay dividend much. ROC, return on capital employed, current ratio 1.16, very close to 1. EPS 77.5. Okay. We should look at some more ratios. But anyway. Price to book, current, okay, book to buys, industry P ratio 6.16, they are 31. I told you it's not comparable. Price to sales 3 times. We can look at a lot more ratios, and you are the experts in looking at the balance sheet ratio analysis. How the sales is growing. When we calculate FCFF, we calculated sales growth, right? How much sales is growing? From March 20, 1,36,000, it became 1,49,000. So what is the percentage sales growth? Let's look at the EPS. 15 rupees has become 20 rupees. Huh? What is that number? In March, 9.39. 9.39 EPS became 20.86. So EPS almost doubled. If you maintain same P ratio, market price also will double. Okay, that's a good thing. Let's see what will happen. Like sales, P&L, net profit. You keep looking at it. Okay, they have given the ratios also. Sales is growing at 6% per annum. Not very great, but recently the changes in the business model happened. I think we can expect more sales. Let's look at Britannia. ROE 46%. What a great return ROE. Dividend yield 4%. Apart from price appreciation, you can make money in dividend also in this company. 45% ROC. Amazing. P ratio 46 times. I think everything looks great. Comparison Nestle India. Nestle is actually more costly. 78 rupees they pay for 1 rupee earnings. 46. Price to book also cheap. 24 times. Let's look at the sales growth and all. Sales growth 11% per annum, profit growth 30%, price growth 82%, ROE 39%. Everything looks great. I think you should invest. Good company to go for. So, which company? That is fundamental analysis. Like this, you can do for many more sectors. Let's say you want to look at Tata Motors because electronic vehicles is the future. Many people think that EV, electronic vehicles. Let's look at then who is doing good ratio in uh, the motors industry, autos in auto. Tata Motors, P ratio and all is not there. I think they are loss making for the last year because of lockdown. Uh, let's look at some ratios. Market cap, okay. Current price, book value, ROE negative because I think they are making losses. Okay, dividend yield they're not paying anything. Okay, so like this, when you look at into the fundamental aspects, how does balance sheet look like? What is the revenue model? What is the intrinsic value? Who is the owner? Management. That is called as fundamental analysis. Let me talk a little bit about technical analysis. Uh, the most popular charts we look at is, let's say, we say trading view. That is a chart we look at, trading view website. Of course, money control is there, many others are there, but trading view is what I use normally. Let's say we'll go for HDFC Bank, or let's say Reliance only. Right? We have been discussing about Reliance. Let's discuss about Reliance. Reliance Industries. So one thing, my dear friend, if you're investing, make sure it is fundamentally good companies. Some people have this opinion. If the share price is falling, I need to buy. If the share price is rising, I need to buy. Don't go for buying and selling immediately. First, look at is it worth it. Then you think when to buy. That is when to buy, when to sell comes from charts. Okay. First of all, let me tell you the basics. Uh, the line chart. How does it look like? X-axis reflect the particular day, and y-axis will give you the points. You join the points, you get a line. That is called as line diagram. But we don't usually use line diagram. We look at histogram. We look at the candlestick chart. And let me tell you, this chart always tells some stories. And stories should always be backed by charts. In the sense, there is two things, qualitative aspect, quantitative aspect. Qualitative means a story around it, a theory around it. You say Infosys is the pride of Indian companies. But is it showing in numbers? We have to look at their P&L balance sheet. Now, looking at the P&L account balance sheet, it's showing so much of good numbers. Or do they have good revenue model? What is in reality? Or they're cooking up some stories, they're fudging the accounts. That should always go hand in hand. About the theoretical aspect, qualitative aspect of a company, like management heading, their qualification, their experience, their futuristic growth, vision, and backed up by numbers. Both should go hand in hand. Don't go look at only one, because nobody knows the future in stock market. Everything should come together. This indicator, that opinion, this opinion. When do many things converge, you make a decision. So line diagram I told you. Before going to Reliance, I think I'll just explain about Nifty 50. You know that Nifty 50 is a representative in Indian stock market, Indian index. Nifty is an index. Index is a notional portfolio comprising of 50 companies, top 50 companies, selected on various grounds. But those 50 companies' performance reflects entire India performance. They are market indicators, representative of the entire industry. So I'll select the historical data. This is the chart of Nifty 50. You see charts, no problem, sir. Going up, down, going up, down, going up, down. It's going up now. Ah, very good. That is fine. But you have to look at what really happened at that point in time. A story will be there. Okay, so let me do one thing. Let me just focus on in the year 1990s what happened. Okay, let's focus on 1991. You remember what happened in 1991? The famous Harshad Mehta scam. Stock market crashed. But best part is within few years it went up. And again it went down. Because in the year 1995 and all, Indian government was not a stable government. BJP was coming, Janata government was there, some 13 parties formed a government. Political stability was not there. Then it was down. In the year 1999 to 2003, okay, look at 2002 onwards, what happened in the market? 2002, it was around 1100 Nifty, and by 2008, it became 6000. Can you do a simple maths? In 2002, it was around 1000, and 2008, it became 6000. Six times, 500% increase in a matter of 6 8 years. We call dream bull run. Market is going up. But observe this, market will never go up in a straight line. It goes up, it corrected. It went down, it corrected. It goes up, it corrected. Goes up, came down, goes up, came down. It goes up, it came down. So we call this as making higher highs. Every time it goes up, it will not fall below previous low. It keep making higher highs. That's where it is bull run. But in 2008, what happened? Market crashed. Economic crisis. Enron crisis. The 2008 bank financial services crisis. I explained earlier. Then market recovered. Was right time to invest. Then market again went down. Now this stage market was going nowhere. It was consolidating from 2010 to 2014, I think. Then it went up. Then again it came down. Now you know what happened in the year 2019-20. That is 20. Corona market fell down, and then V-shaped recovery, and we are now in this range. Okay. So people believe that there is a bull run going ahead. What point I'm trying to tell you is the charts should tell the stories. The stories should be backed up by charts and numbers. Okay, let me quickly show you Reliance. Not spend more time. This will become too much practical. Just want to give an idea. Okay, so Reliance Industries. First, let me move to the most famous chart that is called as candlestick chart. Okay, what do you see here? One second, I'll just remove all these things. Red, green, one line going up, one line coming down. I told you there are four kinds of prices: open price, high price, low price, close price. Four types of prices are there. These four prices are represented in graph. So let me select every day, 1 day range. And look at, okay, let me tell you what happened this few days back. You see this green candle. Green candle means close price more than open price. So I hope you're able to see these things. Look at this candle. This is the highest point, right? Okay, so you can look at this point. This is the high price. The lowest is the low price. That is called as wicks lines. And this point was the open price, and this point was the close price. So high price, close price, open price, and low price. That reflection is calling candlestick chart. Looks like a candle and a stick. A red means close is below. Green means close is above. So we get four types of prices, so we can understand the movements. That is why candlestick chart is preferred. Okay, I'll show you a little bit of larger ones. See how beautifully the chart is looking like. Typically, we call something called as support and resistance. What is support? If share price coming down, we have a support at that price. And if it's going up, there is a resistance at that price. Look at this, either large or small time frame, any time frame you can see. Okay, let's look at this one. You see, this, okay, so look at this. This is acting like a beautiful support zone, right? You see how many times it went down, again it went down, again it went down. You see how many times we have seen this same thing being reached again and again. That's called as support. And once the support is broken, it started coming down. You know what is it called? It's called as breakout. You know, right? Somebody is there to support. If support is taken out, then again you go down. Of course, you find the next support. Now, when it coming back, you see the previous support becomes resistance now. You will not cross it easily. But once you cross it, once the resistance zone is crossed, look at what happened. It went up. Again, you see, there is a consolidation zone or resistance zone where previously it was came down, it is around that. Then what happened? Did it increase after that? Okay, now it is in that range. It is, it's consolidating around this 2200 range, very similar to the previous support, previous resistance zone, right? Previous resistance zone was around this number 2200, 2240, around that zone. So when you're deciding, why should I purchase this share or not, what is this right time now? At this point in time, it looks like once this line broken, let's say it becomes 2300, then you buy. Till then don't buy, because it looks like it is getting consolidated. Or if the share starts falling down from this, it can fall down as low as 1970, 2000. This is the range. 2242, 2000 approximately is the range. If share price crosses this, there is an upward chance movement. This will become support, because now we have breached the resistance zone. If it comes down below this, then it's going to fall further. Otherwise, this will be a resistance zone, this will be a support zone. You can do strategies around these two levels. So marking down things like this: support zone, resistance zone, breakout zone, uh, or falling down, breaking, whatever, breakdown or break up. You can say break up, break down. We say upwards or downside, breaking out or breakdown. Though this kind of charts analysis is called as technical analysis. Here also we have so many kinds of charts. We say different patterns. Okay, I was showing you one thing earlier. Let me just show it to you. Okay, now this pattern, you see, this two times it came down, right? It two times it came down. Or if you see, 1 second, let me look for a particular chart pattern. Okay, look at this. It is now at this stage, it goes up, then again taking rest at this stage, it comes down. So this people will tell like a head and pattern showed, head and pattern, head and shoulder pattern. This is like a head. Seconds. Okay, Okay, so this they treat like a head, and this sideways they treat like a shoulder. So head and shoulder pattern. That means one cycle is completed. You see here also, this is looks like a shoulder, and this leaves look like a head. So like that, they have various patterns where they have cup and handle pattern, flag and patterns, double top, double bottom. So many kinds of patterns are there. You don't have to worry about it. But basically, they are charts, graphs, patterns, indicators. That is called as technical analysis. Uh, I think after this, I'll go to things like. Okay, I think I explained all this candlestick chart and all, head and shoulder, cup and handle, double pot, double bottoms, wedge. So many kinds of things are there. Okay. Can you explain the types of candles? There are so many types, definitely outside our syllabus. They have like morning star, evening star, shooting star, like they say, they have like a hammer. uh, then there are so many kinds of charts. Even we have like Icanashi charts that becomes purely technical analysis. Will not be able to spend that time. Just to give an idea, they call this, see, there is a trend coming down, there is one red bar and then followed by one green one. So that's they believe like a morning star, like there's a trend reversal. It came down, a red candle, then a green candle, it looks like a reversal. Morning star, evening star, a dodgy candle. A dodgy candle means like what happened recent, at the latest. I'll just show it to you. You can see the last one. The last one here is, this is the doji candle, this one. Because you see, it started here open, it went up, came down, but it closed almost same point. Open price, close price is almost same. Only wick is there, body is not there. Open price, close price, more or less same. So you started, you went down here, you went down, you went up, you do lot of movements, but at the end of the day, you stayed where you were earlier. Open price, close price, same. That's called as dodgy candles. So many more names are there. You will come across lot of Japanese names because it's out of Japanese. So that's why lot of Japanese name you will come across. How the questions comes from this topic? Definitely theory oriented. They can ask you technical analysis don't work. Give your opinion. Things like that. Anyway, in my theory marathon session, I've discussed these things in detail. You can go through that. There I've discussed various theories also, uh, and what kind of questions have come in the exam. There I've discussed. But practically, if you want to become a stock trader, then technical analysis is what many people read. Even we have like a moving average. We are going to do problem on exponential moving average. What is moving average? Taking an average. See, for example, if share price is 60, 65, 70, again 68, share price movement is too much. Like this share price, we can't really make any trend out of it. Instead, you take an average of 3. Then next take average of 3. So every year, every day, we take the historical 5 days, historical 10 days, historical 20 days. That's called as moving average. When you plot moving average, the line will be smoother. Let me plot it. Let's see. You see now a lot of clumsiness you can see. Now I'll try to add indicators. Happens. 1 second. Okay. Okay. Indicators. Let's say I'll add moving average. Moving average. Exponential moving average is even more popular. So I'll select moving average exponential. You see, a smooth line is there now. From the movement of this clumsiness, a beautiful line is formed. So moving average, meaning we take the historical average. Now you see that average is always below and the actual number, actual price are above. That means the stock is now trading at a positive number. But I'll just show you the historical ones. Please observe here what happens. What happened here? The line crossed this average line, right? When you cross the actual number from the top, that means you go down further. If you cross it from the bottom, it will go up because it's a trend indicator. We say that you can see it here, the price fell down, then from the bottom it crossed this. Now the market is upward. It touches this, now market is downwards. Now here it also touched, it did not go up much. Now it's very much closer. So you're not seeing much of trend indication. So instead of looking at daily movements, which is very, very fluctuating, very, very volatile, to smoothen it, to suppress the movements, we take an average because average will tell the story, right? Because one day it can be 50 rupees, 60 rupees, 65 rupees, like this, then 50 rupees. If I take an average of 50, this around 55. So average will not move drastically. Share price can move drastically. Average will not move drastically. That's how we use moving average. They have application like moving average conversion divergence. I explained, I've given you. You have moving average and actual price. If actual price cuts the moving average, comes below, there's a much more downward trend possible in the short term periods. Immediate, maybe a week or a month or maybe daily also. You can have not only daily, you can look at this. You can also have various time frames. You can have 3 minutes time frames, 5 minutes time frames. Within a day, what happens? Of course, the more shorter period you look at, the more volatile the market movement will be. Anyway, hope you got the idea about fundamental analysis, technical analysis, how the things will look like. Any questions? One or two theories I will discuss, then we take up problems. Okay, I'll just show you Nifty 50. What happened 2 days back, few days back. I'll select 15 minutes time frame maybe. I usually use 15 minutes. Look at 9 o'clock it started. Look at this one, right? It market went down, it crashed, then it formed a green candle. Basically, you found a support and it started going up. So this we can say support zone. Next time it falls down, and if this is broken, if it is broken, then I think you can see further market downside. I think, in my opinion, market will fall in the next 1 week. Anyway, that you can follow my Hegde said YouTube video for daily predictions. If I little bit go longer, you see how beautifully there will be a support. You see how many times it, and support need not be flat, it can be on a horizontal also. You see it went down, it went, I mean, it gone up, it's went down. Almost here you found a support. Again you found a support here, almost same zone. Again you found a support, but now it is broken, it's down here. Now you are finding support here. I think next time it is again come down, you can see it coming down till here, then it can go up. You can also look at longer time frame for longer periods. So there will always be a pattern. You see, instead of the small movements, small volatile movements, you see beautiful, there is a pattern. It looks like a drawing, right? This is a beautiful drawing. So it's gone up, down, gone up, down, gone up, down, went down, it's gone up, down, gone up, down, down. You see, it's so much clear pattern you can see. And how many times it's around this range. A beautiful support. How much around this time it is there? Beautiful resistance. Now this, it's crossed 2 times. This is called as head and shoulder. Head is there. This and this is called as shoulder. Different. They call it as M pattern. This is W pattern. This is M pattern. So many patterns. There is no end to that. No, so many technical analysis. Okay, and enough of this. Let's get back to our theory parts. Okay, so for fundamental analysis, means I told you, just a quick repetition: company level, industry level, economic level. What are the factors? Economic level, growth rates, national income, what is per capita income. India's saving is so less. India's average age is much lesser than developed countries. So India has got a good potential. Inflation rates in India, how it's going to happen? Recently, inflation data came. It's high. So stock market is falling. So economic analysis, industry analysis. What industry? What is size of industry? Electronic vehicle. Who is spending more R&D on that? Things like that. Product life cycle, is it at a starting stage, developed stage, or mature stage? Things like that. Company analysis, management level, ratio, financial leverage, growth record, size of the company, who is the leader, how many countries they have the presence in. All those kind of things is company specific analysis. Technical analysis, focus on price, patterns, charts. So you see so many kinds of charts you can see. Line charts, I told you, bar charts, candlestick chart, point and figure charts. Again, many charts are there. Head and shoulder pattern, head, right shoulder, left shoulder. I give an example. Double tops, double bottoms, triangle pattern, ascending, descending, flats and pennants, wedge pattern. So many patterns are there. They will not ask you all those patterns. You don't have to worry about it. I just told you few names for your reference. So that so many things are there. Theory question, they can ask you like this: what is Dow theory? Anyway, theory question, theory segment, I've discussed in detail in the theory marathon. You can watch there. Just to give a brief idea, what is Dow theory? Dow theory says market is divided into three segments: primary movement, secondary movement, daily fluctuations. Primary movement means long term trend. You see, if the stock market is like this, you see that you are making higher highs every time, or long term trend is high. Primary movement, it runs up to 3 years, 5 years, more than a year, you can say. Secondary movement is medium terms. Let's say that 6 to 12 months or 3 to 12 months. So if you focus only on this area, it is short term, right? It is short term. So you can have a different view in short term trend. And daily fluctuation, intraday, within this also market will not fall like this. It will down, it will go up, it will down, it will go up, it will come, it will go up. So that's how the stock market goes up. It will not go down straightforward in a linear manner. So the daily movement is called as daily fluctuations. You can have a different view in these three situations. So for example, in my view, next 1 week, market is going to be down. Monday, my opinion, market will go down. Tuesday, my opinion, market will recover. So for Monday, my opinion is downwards, but for Tuesday, upwards. So by Monday alone, what is my point? For Tuesday alone, what is my point? Daily fluctuations. Weekly, what is my point? Monthly, what is my observation? Secondary fluctuation. But in long term, 1 year, 2 year, 10 years, I'm sure market will go up. Primary movements. That is what is called as Dow theory, dividing the segments into three parts. I'll just discuss few more theories are there. Quickly I will cover it, then we'll go for problems. Okay. Next we have efficient market hypothesis. Theory question can be asked. What is efficient market hypothesis? This is basically telling market is supreme. Market is efficient. Market knows everything. Market price reflects everything. You don't have to worry about whether company is doing well or not. Look at the share price. Share price growing, company is doing well. So market price is perfect. Market price reflects all information. Market is supreme. Nobody is above the market. Nobody can predict the market. That is efficient market hypothesis theory. So, efficient market hypothesis and technical analysis are opposite. Why? Because in technical analysis, what we are telling, I can look at the patterns. Looking at the pattern, I can try to predict what could happen. That's what is technical analysis. Looking at the chart. But efficient market hypothesis telling opposite. No, we cannot look at it. We cannot look at the movements. So it's opposite. So to give the example, efficiency is given in three levels. Efficiency in what? Efficiency in weak form, efficiency in semi-strong form, efficiency strong form. So weak form means it will consider price and volumes. By looking at the price, by looking at the volume, if you can predict the stock market movement, if yes, it is showing weak form. Market is not efficient. Market is weak. It is weak in the first level itself. Using price only you can predict. If you can predict, market is not efficient. So if market is exhibiting weak form of efficiency, that means price and volume is sufficient. Semi-strong, not only price volume required, you can also use publicly available information, price data, volume data, publicly available volume information. What is publicly available? Net profits of the company, ratios of the company, company's growth aspects, who is the leader, all information available in the public. If I know this much, then I can predict stock market movement. If yes, it does not form semi-strong efficiency. If you cannot predict, it exhibits semi-strong efficiency. Strong form of efficiency means it will reflect public as well as private information. See, for example, Adani prices went down. Public information is there, right? Some fraud could have happened. Now, if the price starts going up again, now we don't know why stock price is going up, why people are buying. Some information could be there. Some insider information is there. We don't know because of some private information which we don't have. And that is strong form of efficiency. So weak form means depending on price and volume. Semi-strong means price, volume, and publicly available information. Strong form of efficiency means price, volume, public information, as well as private information. We have some empirical evidences we look at in the problems when we are doing. Uh, then we have one more thing here I have not mentioned. The theory must be there. Random walk theory. One more theory question they can ask in exam. Random walk means stock market movement is like a steps given by steps of drunkard person. If some person is coming out of the bar, can you guess, predict how his foot movements will be? You cannot, right? That's how stock market is. Nobody can predict the stock market movement. Don't even try it. That is called as random walk theory. So basically, efficient market theory, random walk theories are against technical analysis. Of course, different theories are there. Everybody is correct to an extent. So that's about security analysis, broadly fundamental analysis, technical analysis, and these theories. We have to take up problems. I think before that, let's take a break.
Theory, random walk theory. This is opposite of technical analysis, because technical analysis we assume we can predict what could happen, but random walk theory is telling you cannot predict. Stocks are complete random. It is like a walk of a drunkard person. You cannot analyze how his steps is going to be. That is random walk theory. So this is exact opposite of technical analysis. So that is what you have. So random walk theory is direct opposite to technical analysis. It's a belief that markets are efficient and it is not possible to beat. In general, it is also true that you cannot beat market. Market is best. You cannot predict what will happen to market. One theory, random walk theory. Next, we have efficient market theory. Efficient market hypothesis says market is superior. But now we are having certain methods to check whether market is efficient or not. In general, we assume that is called as market efficient market hypothesis, EMH. That's a general assumption. That is, we believe market is superior. There is nobody bigger than market. But is it true or not? We are having certain theories, methods. We are having different levels. One is called as weak form of efficiency. Then we have semi-strong of efficiency. Then we have strong form of efficiency. Weak form, semi-strong and strong form of efficiency. In which level the market is in. For weak form, we make use of price only price. For semi-strong, we not only use price, but we also use volumes, meaning how many quantity trades. And strong form means we use price, we use quantity, and we use all available information in public as well as private, meaning all annual reports you read, news channels news you read, you have a conversation with the management, all possible informations. So if by using price only you are able to predict the market price, by using only price, that's what we did so far, I can predict what would happen. That means they are very weak. Now use price is not sufficient, but using price and volume I can predict. That means market is not weak, market is little strong, semi strong. Strong means price and volume are not sufficient. You need large information, then only you can predict the market movements. You can predict, we can apply, you can compare this with some human behavior also. For some people, just tell them something, they start crying. You don't have to do too many things. You do little things. You will go and tell them that you are not good. You are a bad person. They react. They start crying. That they are very weak in their emotional thing. Second set of people will be there. They don't get easily distracted, but you can try with techniques. You can do like you can use certain money, or you can use some friendship, emotional. You can blackmail them some form. That is semi strong. And some people, you have to do all possible efforts. You have to speak to their friends, their parents, whatever the level you have to maybe abuse them physically also. Then they will oblige your words. They are strong form. Or I will say, if I compare this to slightly differently in the public domain, our citizens are like weak. Just somebody telling something, you fall for them. Many democracies failing because of that. You just fail for promise. Somebody tell I will do this, you go and yes, this person will do it. Very weak form of efficiency. Price, just a saying is sufficient. Second level is just a saying is not sufficient, you have to show you the proof also. Just announcements are not sufficient. You have to come and tell in Facebook, putting photo, I have done all these things. Then you say, okay, this person is believable. Third kind of people will be there. That also they don't believe. They say, what if those photos are not correct? You just took the photos only for photo purpose. People are becoming like that now. So you need to prove more data, more analysis. Show the. So you say just a road is there. You have to show the road also. That is the last form, semi-strong efficiency. So democracy also will have weak form, semi-strong, and the strong form. I think as of now, I still believe in India we are still in the weak form of efficiency. From a market point of view, using the price only you can predict. You need price and quantity, and you need more data to predict. Similarly, can we predict CA question paper? By looking at only previous year question paper, can I predict? That means they become weak. That is possible in university question papers. Whether you trust me or not, if you want what is university question paper, take previous year 6 papers. That's all. Nothing else required. Day or not day before exam. On the day of exam, you take previous 6 question papers. Just prepare for that. Those question only will come. But CAs are not like that. Now next level, not just 6 papers. Go to 10 papers. Take RTP, MTPs. Then can you predict the question paper? Then also not possible. Certain papers you can, maybe some medical, some engineering, you may be able to do it. But CA is where you need all public information, all private information, and even then you can't predict because the question paper setters themselves don't know. Because CA Institute will prepare 3 4 sets, and one set will be selected on random basis at the last moment, so you cannot predict it. So that is what is market also: weak form, semi strong form, and strong form. And to predict whether they are weak form or not, we have something called as serial correlation test, run test, filter rule test, and so on. Many are there, 1,000 tests are there, but all these are statistical models, statistical analysis. Statistically, is it happening or not? We don't go by emotions, we go by numbers. So we cannot do all those, we will do just one of them. That's called as run test analysis, and that has come in the exam only one time, some 2008 2010. It has come only one time. After that it is never come. But somehow I keep getting this message from students every time. So this problem, how to do it? This one problem only one time it came, but how somehow students always have that psychological impact. This one question I have not done, this one question. So let us focus on that one question. Okay, this is what you have, please confirm. 9,000, 9,041, something like that. Okay. So now plainly look at the price. What is happening? 9,000 to 9,041. Increasing or decreasing? Then next day, decrease. Next day, next day. So you see that you can't tell you any trend. It is keep fluctuating. That's how market price also there. But what do we do now? We'll take an average. What they ask for? 5-day moving average. For a longer term, we take long number of days. But practically for trend, we look at 250-day average. Any idea why we take 250 days? We take 1 year. 1 year, why 250 days? Because weekends we don't take. 52 weeks into 5, 260 you get. Some days holiday will be there. So we take 250 days represents 1 year. Last 250 days. Because Saturday Sunday price will not be there. Anyway, so we take an average. Longer the period you want, longer the average you are going to take. But this is in class, we can't do 250-day average and all. So I've simply given 5-day moving average. But we don't use 5-day in practical life. We use either a 20-day moving average to know short term movements, or long term means we look at 250-day moving average. So 1 year or just 1 month. 20 days is 1 month. Okay, let's do an average. 5-day moving average. So 5-day moving average will be 9,000 plus 9,041 plus 8,947 plus 8,940 plus 8,966 divide by 5. Simple. Add all the numbers, divide by 5. How much you get? Last 5 days only we take. From that day, I'm computing for 5th day. Last 5 days. History. I'm not computing for first day. Day 1 I can't compute. Standing on day 5, including that day, previous 4 days. So total 5 days. So historical 5 days. Future we don't know what will happen. So the first starting point will be 5th day only. I cannot write 1, 2, 3, 4 because previous day prices are not known. But practical life, every day we will have previous 5 days to calculate. So last 5 days. No, every day 5 day moving average. Previous 5 days. Moving averages because every day it changes. So one day you move, one day you add, and previous day you subtract. So that's how the moving average. That's why fluctuations will not be too high because we take a time horizon of 5 numbers. It will average out. Some may be high, some may be low, but we take an average. So the movement is not very crisp. It is standard. So have the column, first two columns you repeat it. Just repeat the first two columns. Then we'll calculate the numbers. Okay. First 4 days we can't do an average. Then it will become 9,000 plus 9,041 divided by 8947 divided by 5. So how much you get? First day is it 8978.8. So next day you are going to do previous 5 days average. That is starting from day 2 to day 6. 9041, 8947 plus 8950 plus 8966 plus 8995, 8895 divided by 5. Like this you can do for every day. So see numbers. Hope you're getting same. One or two you write compute, then you just copy it down because it's so many. But I just want to show you the process. That's why I did so much. In exam, they will not ask you this. There's one more important thing, which is important for exam. We'll do it. Average. That's all. And Excel, when you copy paste, the formula will get changed automatically, and that is how moving average should be. It should change. So Excel will automatically consider it. And in practical life, we don't use Excel also. People provide charts. We just look at them. We don't compute by ourselves. People make their own different analysis, different strategies. Every strategy may not work, but if you trade without strategy, you definitely will fail. That becomes complete gambling. And somehow The statistic says 90% of Indian investors invest like this. They just invest because somebody told, or I feel like that. They don't little bit of basics. I told you simplest is P ratio. Compute P ratio history. Maybe take an average. Look at their EPS. What is likely to happen? Multiply. The simplest thing also people don't do it. They just invest because they feel like. 90% of the traders, that's why the statistic says 95% of the investors lose. 95% pay, don't make money. There's one, I mean, I don't know whether true or not, but one person told, it seems. One income tax officer asked one CA that why you don't file income tax, why Indian citizens don't file tax returns by providing capital gain information. Why don't they provide? Don't you think they are missing the information? They are not providing correct data. The chart accountant told, let them make profits first, then they will report it with. That is the fact. I've seen so many. I don't have any clients, but I've spoken to many people. They just invest. In some time, they make profits. Even things going well, everything will go up. So you choose any stock blindly, it will go up. But when things go bad, those stock will come down by not 1%, 2%. It will come down by 90%. And that will never come back. So you get stuck like S Bank. You invested, it's gone. Now how much it will not come back. It will not come back to that original price. It happened. Many stocks are like that. India Bulls, Housing Finance, many are examples. In many, even now happening, many stocks are it, but because brokerage people tell, people buy it. So at least you, whoever possible, you may not invest. If somebody is investing, at least tell them. Don't get misled by some news. And people, market will react like that. Some news comes, market will suddenly increase, suddenly decrease. But we should always have control. Okay. So this is one thing. Second, this one you okay? No, before that, look at the average now. How averages are moving? Look at the numbers. 89782, 8957, 8938, 8925, 8923, 8909. You can see there's a clear downwards trend. So this trend can be analyzed in averages. You cannot find it in daily prices. So averages will provide the trend. I told you long term trend, short term primary movement, secondary. This is one of them to identify the trend. Moving averages will help you identify the trend. So in a 5-day moving average means short term basis, the trend is downwards in a short term. Long term maybe more. Exponential moving average. This exponential moving average is important from exam point of view and practically also. See, one level daily price. Because daily prices are fluctuating, we take average, moving average. Within that moving average, some more smoothing we are doing. We are standardizing. That is called as exponential moving average. I'll give you the formula. I'll not give you derivation, but I'll tell you the logic behind that formula. Now, in the average when we do, how did we do the average? Previous 5 days, including today, previous 4 days, we added all, we divide by 5. Means every day we are treating it equally. We are not differentiating different days. Meaning whether this day is 12,144 or next day is 144, both are same for us. We don't differentiate the time period. All history are same. But if you want to give more importance for latest day, my previous day is more important than the days earlier to that. In a way, you can say weighted average to understand. That is what is called as exponential moving average. The concept is, we say EMA, popularly we use it in practical life also. This is also one of the way you can analyze. I'll just give you an idea how the moving averages can be given. You see, stock will go like this, stock price go like this. But moving average is very smooth, right? So it will go something like this. It will not go very fast. It will go very, very smooth. It will go close but smooth apply. So when it crosses from below or the prices are cutting from above, that means the price is likely to go further down, because moving average is always a trend setter. But the moment the price cross the trend setter, something bad is going to happen or something good is going to happen, because average is always a base, long term base. The moment prices comes from the top side and cuts this, that means likely to go below much lower. Similarly, average is like this, and the stock price increase, it cuts this average. You are trading above average, that means you are trying to go, you will go more further, the trend is again upwards. Again, these are all different analysis, none of them is correct, none of them is wrong. We are just trying to understand whichever is most appropriate. So we say whichever suits your strategy, adopt that and trade it. Anyway, let's come to exponential moving averages calculation. It came in the exam also quite a few times. We'll do one problem based on this. Which is the problem you have? Yeah. Closing values of BSE Sensex from 6th to 17th day. That problem. Is number correct? 14,522, 14,925, same numbers, right? Sensex values 14,522, 14,925, same numbers. Okay, calculate the exponential moving average of Sensex during the above period. The 30-day simple moving average of Sensex can be assumed to be 15,000. Value of exponent for 30 days is EMA 0.062. So what we're calculating is 30-day moving average. But imagine if you have to calculate every 30 days, how does it look like? Too many calculations. But effectively, you see, every day you move one further, what is the ultimate impact? When you move one further date, one day is getting added and the oldest day is getting subtracted. So first in, first out is what is happening. So instead of calculating 30 days total, we follow slightly different approach. On one hand we subtract, other hand we add. So I'll tell you how to do this now. So we'll do a columnar format. This is the format we follow. So you can remember it as a formula. So EMA, the average is calculated by, we start from the previous average, previous EMA, then we find out the difference between current price and previous EMA, meaning one price we are adding, and we multiply the multiplier. This multiplier gives us the weight. So previous EMA, current price minus previous EMA. We'll do it in a columnar format. So this is what was earlier, and now you are doing the change. Simple equation like this. Earlier what was there? What is the change I have to do? Change means only difference I'll take. Means what happened today, what was happening previous day, how much is the difference. The difference we multiplied by multiplier. That multiplier will be given in the problem. That is basically weights. How much important the change is. So current price they have given, that you repeat the column, current price. The columns required are, each of this will make a column. Previous EMA is one column. This difference is one column. Multiplier is one column. After considering all these things, today average. Again, this also, if you apply Excel, it's very easy. Put the formula, drag it down. Exam, you don't have that choice. Each of them I'm making a separate column. Previous EMA is one column, the difference is one column, 0.062, that is a multiplier they have given, that is one column, and multiplier, then the all considering the one we get current EMA. That is the last, that is the average last column. So first one, how does it becomes like? First one, what is the previous EMA that they has given the problem? Previous E average can be taken as previous average 15,000. Previous average 15,000. Then how? What is the difference column? Difference column is difference between current price and DMA. That is EMA. 14,522 minus 15,000. The difference. How much the difference comes to? Just the two column difference. That's all. And minus 478. First column minus second column. Current price minus this. Basically, price is falling down. Minus 478. Multiplied by 0.062. Minus 29.64. And that will be the change you should adopt to what? Yesterday price, yesterday average 15,000, and what is the change? Minus 29.64. So it becomes 14,970, and this becomes the opening for next day. Again find out the difference, multiplied by the 0.062 and do the total. Simplest as you can get, just a calculator job. 14,522 minus 15,000 is this number, multiplied by 0.062 you get this number, add this 15,000 you get 14,970. That 29 is the change happening every day. What is the change? Then what will be the next one? Similarly, if you follow, 14,970 becomes the opening, and 14,925 minus 14,970, that comes to 45.36 minus, multiplied by 0.062 you get minus 2.81, and 14,970 minus 2.81 is 14,967. Like that you complete the table. Computer table, then we look at the solution. Okay, I'll put up, compare it. Okay, so what is the trend you can see here again? 970, 967, 983, 15, 130, 246. So even though it is down for one day, but mostly increasing, so you can say there is a upward trend. The prices are increasing, so the upward trend you can see. So similar problems are you can say homework. Quite a few problems are there. You can take it as homework.
Hope you got this question. I think this is examination question. Sorry. So this was exam question. Exam question November 2019. November 2019. Hope you got the question. A typical question which is being asked. Very simple one on exponential moving average. Let's calculate. Closing values of BSE Sensex from 6th to 17th of the month of January of the year 2000 were as follows. Days, date, day, Sensex. Calculate the exponential moving average of Sensex during the above period. The 30-day simple moving average of Sensex can be assumed to be 15,000. The value of component for 30 days EMA is exponential moving average 0.062. Concept of moving average I told you. Instead of taking one day price, we take previous some days average so that the curve will not be fluctuating. The curve will be smoothened because we are taking an average. It's not a simple average, it's going to be a moving average, exponential average. Formula is there for exponential average, but understand the concept. In exponential moving average, the latest day is given more importance than the earlier days. Weights are allocated. How much weight? It is 0.062. Let me explain how to calculate. I'm giving a formula like this. Let's not go behind too much of derivations. Practically also nobody will worry because I told you the charts. A lot of charts in the internet automatically will calculate this. But in exam, you can't do it, right? So I have to explain you the calculation aspect. A little bit of concept you have to understand. So what does this average will look like? Just try to get the overall idea. Formula becomes easier. What is the moving average I told you? I take the average of previous days. Now what will happen? As I move to next one day, the oldest day will get eliminated and new day will get added, right? Like a first in, first out. Like 1, 2, 3, I take an average. I come to day 4. Day 1 will be taken out. Day 2, 3, 4, I'll take it. I go to day 5. Day 5 will get added. Day 2 will get subtracted. So, moving average is always impact on taking one incremental day. And that's what I'm doing. I'll start with previous exponential moving average. Whatever yesterday average, you take it plus the incremental effect I give. What is incremental effect? Today price minus average difference multiplied by multiplier. What is this multiplier? The weightage I'm giving. I told you latest price is given higher weights. So two simple aspects understood. We start from the previous average. We add the today impact. What is today impact? The current price the number minus previous EMA number, that is the incremental effect multiplied by the weight. Weight is the yesterday's weight. That's what multiplier effect, and multiplier effect is given as 0.062. Okay, so let's calculate one by one. Okay, day one. Okay, write the formula once. Current EMA equals previous EMA. I'll start from previous exponential moving average plus the current impact, means current price minus previous EMA. I don't just take the current impact, I'll also consider weight. That's what I call it as multiplier. There is a formula for multiplier that you don't worry, they'll give me the problem. Okay. What is day one? What is the previous EMA? Previous EMA, day one, they said starting point. Starting point, let's say we'll take it as 15,000. They have given. You can take a simple moving average, the previous moving average, 15,000 plus current price. What is current price? Current price is first day 14,522. 14,522 minus previous EMA, that is 15,000, and this you multiply it by multiplier. Multiplier, they have given how much the number weight, basically 0.062. So that is what is going to be current EMA. How much it will be? 14,522 minus 15,000. That's going to be a negative number into 0.062. I think minus 29.64 plus 15,000. I think 14,970, 970.36. 14,970.36. Oh, sorry. I think I took the wrong number, no? Oh, sorry. I think this is not the right data. Sorry, I think this is the wrong data. 34,522 number. Oh, okay. I think I am solving some other problem. I'm sorry. No, I would like to do that exam problem only. This is the question, right? I'm sorry. I think this is the question, right? 35,000. BSN 6, 17th day. 34,522. This was the problem. I think the exam problem. I would like to do exam problem only. I think now the number is correct. Okay, let's do for this problem. So I'll repeat once more the calculations parts. No problem. Whatever I've done, I'll have to write once more. So day 1. So we'll start with previous EMA plus current price minus previous EMA multiplied by multiplier. So previous EMA was 34,520, no, not 34, 35,000. Current price 34,522 minus previous EMA 35,000 multiplier 0.064. 0.064. So 34,522 minus 35,000 into 0.064. You get minus 30.59. So this answer will be 35,000 minus 30.59, 34,969. I think that is correct. 34,969.41. Okay. Now day 2. What is previous EMA? What we just calculated. Okay, they said 3 decimal points. I mean, when they mean uh, 3 decimal points, you can take the, okay, you can take it, but institute has given 2 decimal points only. I think they meant by the thing. Oh, let's do one thing for our calculation. Let's make that 2 decimal point. You can make it 3 also. Institute solution has given 2, so I'll just make it as 2. But in exam, you can make it as 3. Or okay, you can make it as 3. But here I'm rounding it off to. In exam, you can make it as 3. So this 34,969.41 becomes the previous EMA plus current price. Current price is 34,925 minus previous number. Previous EMA is 34,969.41 multiplied by 0.064. 34,925 minus 34,969.41 into 0.064. I think minus 2.84. So this will become 34,969.41 minus 2.84, 34,966.57. 34,966.57. Yeah, you can make 3 decimals. Approximately, you can show it into decimals. It's fine. So like this, you calculate whatever remaining number of days. You have 1, 2, then 3, 4 is holiday. Holiday you leave it. 5, 6, 7, 8, then 12. 5, 6, 7, 8, then 12. You please fill it up. So it's a mechanical process now. I know if you had Excel sheet, you put the formula and drag it down. The problem gets solved in 2 seconds. But in the exam, you don't have that choice. Maybe in future it can come, but some more challenge also can come. Before that, you pass your exams. You write down. I'll give you 5 minutes. You please try on similar lines. November 2019 question. Okay, screen is not visible, but I thought you were trying it. You were supposed to try, so I'm not writing anything. Okay, so if you have done, I'll just put up the solution. For those who have done, you can compare. Uh, for those who have not done, you can quickly take it down. I think these are the numbers you should get: 34,969.41, 34,966.57, 34,982.91, 35,048.01, 35,134.54, 35,253.93, 35,429.67. So those who have done good, those who are not done, you can take a picture of this or you can quickly note it down. Very simple one. Small formula you have to keep it in mind, but repeatedly asked in exams. Evaluator's favorite one, examiner's favorite one. 4 marks, 5 marks, 6 marks, around that range. Depending on how many days they give, around 4 to 6 marks you can expect. More of mechanical one, nothing much interpretation. Okay, if you want to interpret, you look at the numbers. You see 35,000, look at the current price. Does it showing any trend? 522 to 925 increased. Then 35, it increased, 36 increased, oh increased, increased. Okay, now it's actually everything is increasing. So it should be trending only. But in sometimes when the price are increasing, decreasing, but that over a long time, how the trend is looking, the moving average will tell a better picture. But here anyway, everything is increasing. So we can say that trend is positive. You can see that moving average, numbers are increasing, trend is positive. But coincidentally, current market price is also positive, but practically that will not happen. Practically, the prices will be fluctuating, but average will give a consistent movement. So we can show that we can see the trend upside or downside. Okay, hope you have done. I'll go further. An application problem on market hypothesis. Looks big problem, but let me tell you, easy problem. Let's read. The directors of Implant Inc. Wishes to make an equity issue. Okay, they want to issue equity shares to finance $10 million expansion scheme, which has an accepted accepted. I think it's not accepted, maybe accepted. Anyway, a net present value of 2.2 million. So you invest $10 million in PV, $2.2 million, and to refinance existing 6 million 15% bonds due for maturity in 5 years time. Refinance means you're having a debt, you're having a bond due for maturity, you have to repay, you need money for that to repay, so you're using equity shares. So basically you get money from equity share, you use it for repayment of your bonds. For early redemption of these bonds, there is a 3,50,000 penalty charges. If you remember, we have discussed uh, in bond replacement and all. If you are redeeming the bonds earlier, you have to pay some premium payable on early redemption. That's what here called as call premium there. Here penalty charges. Example I gave you, housing loan pre-closure charges. So basically they are redeeming the old bonds and issuing the shares. Because you're redeeming the old bonds earlier than maturity, you are paying extra. So how much money you need actually then? 10 million you need for financing a project, then 6 million you're redeeming the old bonds, and you're also paying penalty 3,50,000. And where does get money offer all these things? That is from new issue. The company has also obtained an approval to suspend these preemptive rights and make a 15 million placement of shares, which will be at a price of zero point 0.5 per share. Approval to suspend preemptive rights. Do you know what is preemptive right? Company law students, right shares. You know that it was supposed to be offered to the existing shareholders first, right shares. But they have obtained approval to suspend. So no right shares, everything is given to public. And at a price of zero point 0.5 per shares. And make a $15 million placement. Okay. The flotation cost of issue will be 4% of gross proceeds. Any surplus funds from the issue will be invested in IDRs, which is currently yielding 10% per year. The present capital structure is as under. Ordinary shares means regular equity shares, 1 per share, face value 1. Share premium, free reserves, 10% bonds, debentures. Current share price is 2 per share and the debenture price is 103 per debenture. Cost of capital of the company is 10%. It may be further presumed the stock is semi-strong form efficient and no information about the proposed use of funds from the issue has been available to public. You're required to calculate the expected share price of the company once full details of the placement and to which the finances to be put are announced. Okay. Basically, we have to calculate expected share price. After all these issues have been made, what will be the final numbers? Okay. So much they have given. What are the activities that is happening? We have to calculate expected share price of the company. What is simple formula for expected share price? Market value of the company divided by number of shares. Now, market value. What and all the aspects of market value? Existing market value will be there plus two additional events we are doing now. One event, we are entering into new project. That value will get added. And another, we are redeeming the bonds earlier than original maturity. So because of early redemption, we also get some value. I think we get some value because if it is a loss, why will I redeem it? Anyway, we'll calculate. So existing value plus the value from the project plus the value from replacing the bonds. That will be the total value of the company. Divided by number of shares will be the market price per share. As simple as that. So let's calculate. Market price per share is calculated by value of company divided by number of shares. This is a basic formula. Now, value of company comprises of three aspects: existing value, then value from the new projects, and third, value or benefit from early redemption. Early redemption. Okay. So let's calculate this. What is existing value? Existing market price per share, 2 per share. We are having how many shares? 7 million, right? 7,000 means 7 million. Face value 1 rupee only. So 2 rupee per share into 7 million. That is 14 million. Of course, everything in dollars. The foreign currency dollar, not much of importance here. Actually, one more also we can add. We are issuing the shares, right? So when you issue the shares, whatever net amount will get added. That also I'm going to add it because that is required. It's also amount gets invested. So I can do one more. I'll just make it here. I'll make it here. So I have some space here. So I'll do it here itself. B. This I'll make it as C. This I'll make it as D. Net proceeds from issue. I will say net proceeds. Net proceeds because you will have some issue expense also. So net proceeds from issue. Net proceeds from issue. Uh, how much amount we are raising? We don't have to calculate and make a $15 million placement. They have given directly at a price of 0.5% that you leave it. They directly told 15 million placement of shares and flotation cost will be 4%. So 15 million you receive minus 4% flotation cost. So 4% of 15 million. 15 million into 4% means 6 lakh. I think if I subtract 14,040,000. 14,040,000. A value from the new project. A new project is take only net present value. Investment you don't take it. Investment if I take it, then it will be duplication. Because investment where the money comes from, money comes from net proceeds. So you take the net proceeds also, then you take the investment also. That will be duplication. Proceeds anyway we have taken. So let's compute the NPV only. Net present value 2.2 million. 2,200,000. 2.2 multiplied by 1 million. 1 million means 6 zeros will be there. 2.2 million. So 2.2 multiplied by 10 lakhs. 1 million means 10 lakhs. 2,200,000. Okay. Then what is the benefit from early redemption? I think I need a little bit more space, so I'll write it at the top. Value from early redemption. Value from early redemption. Can you repeat this? Tell me which part of the calculation. Should I repeat the existing value calculation, or net proceeds from new issue calculation, or NPV calculation? Because NPV I need not calculate. NPV given only, no, in the problem. The expected net present value is 2.2 million. So I'm taking it directly. How to calculate 2.2 million? That calculation part is it. New proceeds 14.4 million. Correct. Okay. The zeros are missing. It is 14.4 million. I'll just correct it. It's 14.4 million. So 14,400,000. Now the number looks correct. And people who are asking how to convert into millions and all, one process you do. 1 million means 10 lakhs. So 2.2 million into 10 lakhs you can do it. But I don't convert that into lakhs into million. For me, that is confusing actually. I'll keep it very simple. Millions means 6 zeros. I count the number of zeros. Billion means 9 zeros. Here we have 2.2 million. So 2.2 multiplied by million. What is million? Multiplied by 6 zeros. 6 zeros is million, 9 zeros is billion, 5 zeros is lakhs, 7 zeros is crores. That's all. I just keep it in 5, 6, 7, 9. 5 zeros means lakhs, 6 zeros means million, 7 zero means crores, 9 zero means billion. I count in number of zeros. I am comfortable that way. Or you can do 1 million is 10 lakhs. You can take 10 lakhs and calculate. So 2.2 into million. So you get 2.2 million, which is 2,200,000. Hope everything is clear. Okay. So now comes to value from early redemption. What is early redemption? It was the bonds were due after 5 years. Had I redeemed after 5 years, what would have happened? And I'm redeeming now itself. Because of that, what is going to happen? Okay. So I'll just calculate two things here, A and B. If you redeem after 5 years, what would have happened? Redeem after 5 years. We calculate what and all is going to happen. For 5 years, you have to pay coupon, and last year, you have to pay redemption price. So you compute the current market price, like the way we used to do in bond valuation. How coupon, I can use annuity factor because it comes every year. Redemption price, I'll use discounting factor. So how much coupon I'll have to pay? Bonds, 15% bonds on 6 million. So 6 million is the face value. 15% coupon I have to pay multiplied by annuity factor. Directly you can do. You don't have to show too much of calculation. What is annuity factor? Cost of capital of the company 10%. For how many years? 5 years. So what is the annuity factor going to be? 1 by 1.1 press equals to 5 times GT. 3.7908, or let's say 3.791. I'll take 3 decimals. 3.791. 3.791. This is the coupon payment, which is coming to 6 lakh, 6 million into 0.15 into 3.791. 34,900. This is coupon. Then what about redemption value? You will have 6 million. Oh, this is 6 million. I will calculate correctly. 6 million into 0.15 into 3.791. 3411. Correct. It's fine. So then 6 million multiplied by last year redemption value, I mean discounting factor. Discounting factor is 0.621. 6209. I'm taking 3 decimals. 0.621. 6 million means 6 followed by 6 zeros into 0.621. 37 lakh 26,000. 37 lakh 26,000. So present value becomes total 34,11,900. 71 37,900. 71 37,900. Okay. Now if you redeem immediately, how much you have to pay? You have to pay no interest, but penalty charges you have to pay 350,000. So 6 million plus 350,000. 6 million plus 350,000. 0.35 million. So 6 million 350,000. So what is the difference you get? I think 787,900. 787,900. So again repeat, redemption coupon multiplied by annuity factor, redemption value multiplied by discounting factor. I do the total, I get present value 71,37,900. But if you redeem immediately 6 million face value and penalty charges 3,50,000 means 0.35 million. So 6 million 350,000. So saving what I'm going to do 787,900. This NPV from redemption of the bonds. I'm taking only NPV from the bonds. because I'm not taking existing bonds into a consideration and equity issue. Two times I'm not considering because equity issue will include the value of bonds also. I repeat again, equity issue will include the value of the bonds. Equity issue will include the investment made. So bond value I'm not taking separately, only incremental bond value NPV I'm taking. Investment in the new projects I'm not taking separately, only NPV I'm calculating it. Hope you understand. So what is the total of this? I'll write in the next slide. I don't have much space here. So 14 million, 14 million 400,000, 2 million 200,000, 7 million or 7 no 787 900. So if I do the total, you can do the total. I'll write in the next slides. So total value 14 million plus 14 400,000 to 200,000 787 900. So 3 million 3 crore 330 313 87 900. So total value 313 87 900 31 million divided by number of shares. How much shares? Existing shares plus new shares. What is existing shares? Existing shares is 2 million, right? No, 700, 7 million. Existing shares is 7 million. New shares. New shares, how much we raised? We have raised $15 million by issuing the 0.5 per share. So it will be 15 million divided by 0.5. You get 30 million plus 7. So total will be 37 million. So value per share after new price, after all this impact, market price per share 31387 by 37 million. 0.848. That's all. Okay. So 0.848 per share. So simple process, existing value plus new value. Where and all new value come from? Issue proceeds, net proceeds, NPV from the new project, then NPV from redeeming the bonds, add all, you get total market value, divide by number of shares, you get the value per share. Okay, hope it is done. Okay, I'll go further. Okay, so let's come to the next problem. Problem looks terrifying, horrifying, frustrating, irritating, confusing. Examination problem, November 2020. I think many students have got heart attack also maybe. But not now, but I think January 2021 by looking at this question in the exam. January 21. No? Okay, fine. So this looks difficult. Actually, it is very, very simple. Let me explain how. I hope you got the question, first of all. Did you get the question? Yes. Okay. I mean, just to get that one answer, I have to repeat so many times. I don't know what other points you're able to understand. Mr. X is of the opinion that market recently shown weak form of efficiency. In order to test the validity of this impression, he has collected the following data relating to the movement of Sensex for last 20 days. Open, high, low is all values within a particular day. We ignore it. So whenever they give you this table in the examination, this has no relevance. We have to look at only the close price. Just to increase blood pressure of students, just to increase the complexity feeling, in the exam they'll give you big table. You have to focus only on what is relevant. You're required to test the weak form of efficiency using autocorrelation test taking time lag of 10 days. Very simple problem. How? They're asking, they're telling market is weak. We have to tell. How do we tell market is weak? They said take 10 days gap. So we divide this into 10 days. So we'll divide into two parts. First 10 days and next 10 days. And what we have to do? For the first 10 days, you calculate returns. You know returns, how do you calculate? Current price minus previous price divided by previous price. You get first 10 days returns. Actually, you get 9 days. Next 10 days returns you get. Returns for first 10 days is there. Returns for next 10 days is there. Between the two, see whether there is any correlation. If the correlation exists, that means movement is same. We say market is weak because correlation same means movement can be predicted. If correlation is not same, if correlation is weak, then we say market is stronger. What is correlation? Actually, we are going to discuss that in portfolio management chapter, but I'll give a quick idea about it. Between two variables, if the two variables are related or not, price, demand. We can give various example. We say like gold price and stock market index are inversely correlated. Because if stock market goes up, gold price comes down. If stock market comes down, gold price increase. We say inversely correlated. Price and demand inversely correlated. US stock market, Indian stock market, we say positively correlated because when global market goes up, Indian market also goes up. So when you're trying to understand the behavior between two variables, whether they are relevant or not, we take the help of correlation. If positive correlation comes, a strong correlation comes, then we say that the variables are dependent. If correlation is less, then we say variables are independent. We are applying that logic in this problem. First 10 days, you get 9 returns because 2 days you get 1 return. So 10 days you get 9 returns. I will calculate. Next 10 days you get 1 more return. So 2 data sets we have. Compute correlation. If correlation is high, variables are dependent. Market can be predicted. If correlation is less, variables are independent. Market cannot be predicted. If market can be predicted, market is weak. Market cannot be predicted. Market is not weak. As simple as that. Okay. So first let's calculate the returns. So first 10 days. Returns for first 10 days. Returns for next 10 days. How do we calculate? Very simple. Let's say this I'll call it as X. This I'll call it as Y, two variables. Current price minus previous price. 33,434.83 minus 33,453.99. Current price minus previous price divided by previous price. 33,453.99 multiplied by 100. Current price minus previous price into 100. Divide by previous price into 100. 33,434.83 minus 33,453.99 by 33,453.99 into 100. I think you get minus 33,434.83 minus 33,453.99 divided by 33,453.99. Okay. Okay. Don't do into 100. Let's just keep it as absolute number. Actually, it should have been into 100, but anyway, let's keep it not divided by this. Let's just keep the absolute number. Just tell me absolute number. Divide returns. We don't want it. Just keep the absolute number. 33,434.83 minus 33,453.99. Absolute number we take. Minus 19.16. Absolute number. Then difference between next two. 33,431.93 minus 33,434.83. Just find out the difference, absolute difference. I don't want percentage. 33,431.93 minus 33,434.83. Is it minus 2.9? Okay. Then 33,383.41, 33,384.31 minus 33,431.93. Minus, again minus 47.62, 33,431.93, 33,383.41, 383.41. Oh, sorry, 383.41. 33,383.41 minus 33,431.93, 48.52 minus, right? Minus 48.52. Like that, can you give me for remaining days numbers? Okay, let me also calculate along with you. 33,370.93, 33,370.93 minus 33,383.41. 33,370.93 minus 33,383.41 minus 12.48. Next, 33,370 over 33,340.75, 33,340.75 minus 33,370.93. Again minus 30.18. Okay, you please calculate this, my dear friends. List up to this for first 10 days you calculate. Remaining 9 days, you're going to calculate like this. You're starting from 11th, that is 33 to 51, 33 to 51 minus 0.53 minus 33 to 59.03. 33 to 51.53 minus 33 to 59.13. I think minus 7.16. No, no, 11th days. No, don't calculate for 11th. Calculate for next day. This is 9th day. So calculate from next day. That is this two difference. 33 to 85.89. 33 to 85.89 minus 33 to 51.53. 34.36. Okay, I'll give you 5 minutes. Like this, you please calculate. Basically, difference between today and previous day. That's all you have to calculate. I hope it is not a difficult one, mechanical one, right? Okay. If you have done, please see if you get these numbers like 90 minus 19.16 minus 2.9, 48, 12, 30. So these are the numbers. We have it. If you have calculated, good. If not, you can quickly take it down. But do calculate one or two numbers and see if you are able to calculate correctly. It's a mechanical one. I hope you'll be able to do it. In Excel, it's a matter of seconds. Current minus previous, drag it over. Of course, in exam, you can't do it. I don't know why institute has so much of grudge against students. At least they could have avoided decimals here. What's the point in you doing decimals in exam? Oh, no, no. Maybe they have some objective, but to test the concept, decimals has got no role. Just the numbers would have been sufficient. So have you got the return? You get 9 values here, right? 1, 2, 3, 4, 5, 6, 7, 8, 9. 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 values you got. I hope you are done till here. If not, you can just copy it down later. I'll continue further. Okay. What we have to calculate is R, correlation coefficient. Concept I will discuss in the portfolio chapter. Actually, you should have known by now. But anyway, correlation formula is this. One is covariance between x and y divided by standard deviation of x into standard deviation of y. This is logical formula, very conceptual formula. I have to give explanation also. But computing covariance, computing standard deviation, lot of decimal points are there, becomes too complicated, too long process. So one short formula is there. Many people may not trust me, it's a short formula, but you have to trust me. Because covariance, standard deviation, if I start calculating, it will be even more complicated, even more lengthier. So I'll give the one direct formula because covariance formula is there. Summation x minus x bar into y minus y bar divided by n. Standard deviation, we need x minus x bar whole square. So what are the columns we require? X minus x bar whole square, y minus y bar whole square, x minus x bar into y minus y bar. Too much decimal calculation. We will do all those things. We will do when we come to the portfolio chapter. We will do. We don't skip it. But as of now, let's directly give the formula for R without worrying about standard deviation covariance. Formula looks like this: n into summation xy minus summation x into summation y. Simple formula. Summation means total. Xy means multiplication. N means number of observations. So n here number of observation becomes 9. 9. That is numerator. Denominator, same thing, but I'll square it. N into summation x square minus summation y, the whole square. I put square root for this. Similarly, for y, n into, this is summation x. I'll write once more because my handwriting you may not be understand. N into summation x square minus summation x whole square. N into summation y square minus summation y whole square. Square root. You can do once full square root also. X column, Y column, we already have it. What are the other columns we require? XY column I require. X square column I require. Y square column I require. That's all I require. 3 columns I need. Otherwise, x minus x bar, y minus y bar, x minus x bar whole square, y minus y bar whole square, x minus x bar into y minus y bar. 5 more columns I require if I follow the previous formula. This I need only three formulas, 3 columns, sorry, 3 columns. how to pronounce COV? Covariance. But the formula for covariance and all I have not given yet. So don't worry about that part. That formula, logic, everything we discuss in portfolio. Okay, let's come back. So what are the columns I require? I require columns for x square, y square, x into y. What is x square? Minus 19.16 into minus 19.16. It becomes plus. So 19.16 into 19.16. In calculator, you can do even more faster. 19.16 into equals. You get the number. How much? 367.11, right? 19.16 into 19.16 or 19.16 into equals. 367.11. Then 34.36 into 34.36. 180.61. Then multiply the two. Minus into plus. So negative comes. 19.16 into 34.36. Is it 658.34? So 19.16 square, 367.11. 34.36 square, 1180.61. Then 19.16 into 34.36, you get 658.34. But because 1 minus 1 plus, when you multiply, minus only comes. So minus 658.34. I hope you will be able to complete this table. So try to calculate. I'll do one more. 2.9 square is 8.41. 2.9 into 2.9. Minus minus becomes plus. 43.39 square. 1882.69. 1882.69. Then the minus 2.9 into 43.39. That comes to 125.83. And 1 plus 1 minus. So minus comes. Hope you understood. Please complete the table. Okay. You please try it. I'll give you 2-3 more minutes. I need total also. Total of this column also. Okay. If you have done x square column, please check it out. Some decimals here and there it comes. That's fine. Okay. Y square column, x into y column. When you do x into y, just be careful. plus minus when you multiply. Plus minus you multiply, minus comes. Minus minus you multiply, plus comes. But square you don't have to worry because square means everything will be positive only always. X into y. Okay. Please check out if you got these numbers. X square column, y square column, x into y column. Some decimals can be here and there, but approximately see if you get the answer like this. So this is summation x, total of x. This is summation y, the total column. This is x square, so summation x square. This is summation y square. This is summation x into y. N number of observations 1, 2, 3, 4, 5, 6, 7, 8, 9. 9. Not 10 days, because in 10 days, the difference if we calculate, one shot always will come. Like 2 days are there, 2 minus 1, only 1 day I can get. 3 days are there, second day minus first day, third day minus second day, only 2 days I'll get. So always one shot will be there. Keep that in mind. So n equal to 9. 9 pairs, 9 days, 9 observations. Let's substitute in the formula. R equals n means number of observations 9, summation xy 164.68. N summation xy minus summation x summation y, that is minus 194.96 and 68.08. Summation x into summation y. N 9, summation xy, last column 164.68 minus summation x into summation y. Summation x minus 194.96, summation y 68.08. Whole divided by n into n means 9. Okay. Summation x square 6848.67 minus summation x the whole square. Summation x is minus 194.96. You square it. You can take a square root. What you did for x, do for y also. Otherwise, y will feel bad, right? Same repetition. N 9 summation y square, that is 6745.76 minus summation y whole square 68.08 whole square. We have to simplify. In fact, in your foundation level, many of you would have skipped mathematics statistics. Statistics in correlation, you would have learned all these formulas. It used to come for 1 mark. In final, it's coming for I think 8 marks or something. It is 8 marks question. That's why. Had you not learned correctly in foundation, now you're learning again now. Anyway, so write down till here. I'll do calculation after 2 minutes. If you have any doubts, you get clarified. I'll just show you the arrow mark, which number I'm using where. Summation xy, that is what is 164.68 summation x minus 194.96 summation y 68.08. That's a numerator. Denominator n is 9 summation x square, that is 6848.67 summation x the whole square minus 194.96 whole square. Same thing for y, n is 9 summation y square 6745.76 summation y the whole square 68.06. Okay, let's calculate. We can use the calculator function to simplify this faster instead of writing it everything. This we know minus into minus becomes plus. So let's use the m plus function in the calculator. So do what I follow. I mean, I'll just wait for one more minute. Hope you have done till here. Okay. Can you confirm? Okay. So let's do this in calculator together. 9 into 164.68 equal to m plus. Keeping in memory. 194.96 into 68.08 equal to m plus. Then MRC. Think 14,754.9968. Okay, 14,755. Numerator, I think that's what you're getting. Denominator, uh, let's clear the calculator memory. Start fresh. 9 into 6848.67 equal to m plus. Keep it in memory. 194.96 square means you do into equals. This has to be subtracted. So m minus. Then MRC. I think 23,628. I'm just taking round off. 23,629. 23,629. Of course, square root is also there. Then once more, calculator, clear calculator memory. 9 into 6745.76 equal to m plus. Then 68.08 into equals. I'm squaring. M minus. I'm subtracting. MRC 56,077. Okay. So how do we calculate next in the calculator? Again, little bit fast, I'll tell you. You don't have to write down this anywhere. This much directly you can calculate. Follow the process I told you. I am telling you. 14,755. When two numbers are in denominator, what should you do for faster calculation? Keep dividing it. Keep dividing it. But square root is there. We'll calculate square root. So 14,755 you calculated. Divided by 23,629. square root equals. Don't stop at that. Again divide by 56,777 square roots equals. You get 0.405, I think. 0.405, right? 0.405. 0.4, let's say. In fact, in Excel, it's a matter of seconds. You select the column X, you select the column Y, equal to correlation formula is there, you get the answer. Anyway, so practically how to apply, we can apply this in stocks, index and all. We'll discuss in portfolio management. I'll show you Excel formulas also how to do it. But when I come to the portfolio chapter. But as of now, hope you got it along with calculator techniques, how to calculate faster. So what is the interpretation now? Now, R, correlation coefficient, can lie between -1 to +1. That is extreme numbers. +1 is positive, -1 is negative. So if it is towards +1, we say high correlation. If it is towards -1, high negative correlation. But this is 0.4. So middle, right? 0.5. So we don't say high correlation. If it is towards 1, high correlation. Towards 0, no correlation. 0.5, we say moderate. Around 0.25, low correlation. Easy to understand, right? Around 0.75, around 1. That is high. Maximum is 1, of course. Close to 0, 0, no correlation. Around the 0.5, 0.4 is close to 0.5, middle. So we say moderate correlation. So you write down, there is moderate correlation. There is moderate correlation between the returns of two periods. There is moderate correlation. There is moderate correlation between the returns of two periods. Moderate correlation between the returns of two periods. Between the returns of two periods. Between the returns of two periods. Now you tell me, what is the conclusion? If there is moderate correlation, that means variables are not strongly related. They're related but not strong. So we say that variables are not dependent. So variables are independent, which means first 9 days return is different. Next 9 days returns, 10 days, 10 days is different. Means market is not dependent on first 10 days and 10 days. In other words, looking at the first 10 days, I cannot predict what could be the next 10 days. So market is not weak. So write down the sentence. Since correlation is not strong, since correlation is not strong, correlation is not strong, correlation is not strong, market movement cannot be predicted. Since correlation is not strong, market movement cannot be predicted. Market movement cannot be predicted. Market movement cannot be predicted. Hence, market does not exhibit. Hence, market does not exhibit weak form of efficiency. Hence, market does not exhibit weak form of efficiency. Market does not exhibit weak form of efficiency. Weak form of efficiency. Is it worth solving the exam keeping the time frame? See how much we have taken this problem. 40 minutes I've taken with explanation, waiting for you to solve. If I did direct calculation, it would have taken hardly maybe 20-25 minutes. Is it worth it? Definitely, I would say yes. For 8 marks, I would say yes, because every question will not be this much, right? You say like this, This is only 8 marks. Why should I spend 25 minutes? The question is this. In the 25 minutes, will you know any other question from the material? I mean, in the question paper, if it is a question between this 8 mark versus this 8 mark, then you choose whichever you can do fast. But here you know how to solve. Other question you don't know how to solve, you choose this. So the question whether is it worth it or not, that depends on whether you know the other question or not. See, derivative forex problem, 8 marks question, let me tell you, you can solve it in 5 minutes if you know the answer. But in the examination, I've seen most people don't solve derivative forex problem because it's easy to calculate. I mean, time frame is less, but complicated to think. So there is always a balance you have to maintain. That is time consumption versus complexity. This is not complex, it's just time consuming thing. Portfolio also will be similar, but all other problems I would say will not be time consuming. And in examination, it's always the average which works out, right? Every 8 marks problem will not be 10 minutes. No, it's not that. From 8 marks problem will be 20-25 minutes, and some 8 marks problem will be 5 minutes, 6 minutes. On an average, you have to maintain. And one more thing I should tell you, you will not attend for 100 marks in exams. If you know every answer, good. So what you have to do in exam always, prioritize. When you get the question paper, either 15 minutes earlier or at exact 2 o'clock you get, first you should always determine the order in which you solve the problem. So is it worth solving this problem? I will say, if you think it's time consuming, keep at the last. By looking at the question paper, you do this I don't know, this I don't know, this I don't know. You have 2.5 hours with you. But if you don't know which problem to solve, so solve it in the order of priority. Which you can solve first, which takes short time. Maybe forex derivative. You solve it. Then you will have these lengthy questions keeping at the end. If time permits, solve this lengthy question. If does not permit, you don't solve. When the problem arises, you take up this problem at the beginning and you spend 45 minutes on this. Then you feel bad. Oh, this question I should not have done. So, what is important from all this discussion? When you write mock papers or when you write this problem in class, by looking at this problem how much estimation time it will take. You need to have that experience. That experience comes from practice. That experience comes from mock exams writing. By looking at the problem, you should be able to judge, how long it takes. Like a project management in a larger company. Okay, this problem takes time. Then let me solve not first, time consumption. Let me solve it later. I always keep this example, right? Instead of solving this 8 marks question in 20 minutes, you leave it, you solve other questions because there is opportunity cost. Instead of solving one big question, you can solve 2 smaller problems maybe. Like one 8 marks question like this, it would be around, let's say, 20 minutes it will take. But 6 marks, 2 questions you can solve in the same 20 minutes. So 8 marks you lose, but 6 plus 6, 12 marks you get. So 4 marks extra you get. Opportunity cost is there. But when there is opportunity cost, only when there should be opportunity. If you don't know that 6 marks question, at least solve this problem. How do you get that? Prioritization. So solve the problem which you think are faster, solve it first, which takes time, you take it later, so that you don't regret after coming out of exam hall. Exam tricks, selection of questions based on marks. For that, I've already done ABC analysis on my YouTube channel. You can search ABC analysis by Chinmaya Hegde, or like what chapter to be focused, how much marks every chapter has come from, tabular presentation, how to present in the exams. So all these things I've already done a separate video, and also like chapter specific, what are the key points, what are the preparation strategies you should need to do. So all those things I've already done in my YouTube channel. It is there. You can watch it. So I'll be doing that examination pattern analysis. I'll be doing it every attempt. Just before exams, I'll be releasing the guest paper also. So you can go through that. As of now, it is already available in my YouTube channel. you can go through it maybe slightly later, because you need to have some knowledge before you watch that video. So after you complete the classes, then you can watch that video. You'll get a better control as to what to do be done in examination with respect to SFM. I'm not talking anything in general, only with respect to SFM. Okay, hope you got this. Many people think complicated. At least you tell me. I understand it is lengthier. Is it complicated? It's mechanical, right? It's lengthier. I don't think it's complicated, but some people complain, oh no, what question is out of the world, out of syllabus. Anyway, so that's it with respect to this chapter at this point in time.